how do you access money in an infinite banking policy? We're going to dive into that today. First, make sure to hit that subscribe button so you never miss another video. Let's get into the subject, which is how do I take money out of my infinite banking policy? I really want to first help you understand infinite banking as a whole. So I'm going to go really high level, 30,000 foot view. We're going to drop back in and help it get closer and closer, more and more clear. Infinite banking in general, for most people, they're using these policies to create wealth. So when you start an infinite banking policy, you're funding an overfunded or a max overfunded dividend paying whole life insurance policy. That's the first step. Make sure you get a good company that has a history of producing solid dividends. You want a company that's been around at least 100 years and specialize in these kind of policies. So first thing is max overfund a dividend paying whole life insurance policy. Once you've capitalized the insurance policy, you will then have the ability to access a much larger bucket of money, which is the general account of the insurance company. Okay, so because you have a life insurance policy with the insurance company, you get access to their general account in the form of a loan. So then what happens is you're going to request a loan from the insurance company. Let's say you put in $100,000 into the policy. That's the first year of funding. You want to take back out $75,000 to go out and invest in a single family rental property or a multifamily syndication. And you're going to do that in the form of a loan. That loan typically is going to take roughly 5 to 6 days in terms of processing from the time you request it to the time that it actually hits your account and it's ready to go. So take that into account when you're taking loans from your infinite banking policy. Once you've taken the loan out, you can use that capital however you want. There's no terms on these loans. The only term that the insurance company sets is the interest rate that you're paying. Other than that, you don't have to amortize it in any certain way. You can pay it back in 6 months, or you could take 20 years, 30 years, 10 years. It's totally up to you how you repay these loans, which is pretty phenomenal. In fact, even if you don't repay the loans, the death benefit eventually will pay out, and that death benefit will first pay off any outstanding loans, and then the remainder will go to beneficiaries. So with that being said, you want to pay back those loans, right? And I'll tell you why. But first, let's get through the process. So what's happening is we took that loan, we invested it. That investment is now producing some sort of cash flow. So we're going to take that cash flow and we're going to first apply it to the simple interest on the loan from the insurance company. This is pivotal to the infinite banking strategy. You want to make sure that you're keeping the interest that you're paying simple, because over time, if you pay simple interest on a decreasing value and you're earning compounding interest on an increasing value, there's going to be an added layer of profitability for you, right? That's the whole concept of infinite banking, is that you are benefiting and growing your wealth while you're using your money in two different places at the same time, right? Inside the policy and outside the policy in an investment. The first money that comes back in the form of cash flow from these investments, we apply it to the simple interest on the policy, make sure that we keep that interest simple. Anything above the simple interest, so if you have extra cash on top of the simple interest, you want to apply that first to new funding. So if you haven't funded it, let's say you're in year 2, you haven't funded it for that year, we're going to first apply that extra cash flow to get that policy fully funded for that next year. If you've already fully funded your policy, then you're going to work on paying down the principal on that loan, okay? Because if we can pay down the principal on the loan, the quicker we can do that, the quicker we're able to turn around and take another loan and invest it into another deal. So to recap, you capitalize your whole life insurance policy that is specifically built as an infinite banking policy. You turn around 30, 60 days later, you take a loan from your policy that's coming from the general account of the insurance company, which, key point there, means your money is staying in your cash value, earning compounding interest. You take that loan and you invest it into a cash flowing asset. As that cash flowing asset produces a return, you first pay down the simple interest, then you pay any new premium for the next year, if you can. If you've already done that, then you pay down the principal on the loan of the policy, and then you repeat that process over and over again, and you'll continue to build more and more wealth. How do you access those loans? You can go directly to the insurance carrier themselves. You can call the customer support line and request that loan, or if you've got a good financial professional that can help you with this, you just need to shoot them an email. All of my clients just shoot me an email and say, hey, Brennan, I need a $50,000 loan for my next investment. Can you process that for me? My team processes it. That loan or that money hits their account a few days later, and then they're off and running. Most insurance carriers will have a portal or an online portal that you can go in and plug in the simple interest or pay down the principal or fund new money into the policy. So it's relatively straightforward from an insurance company perspective. In terms of requesting a loan, most people just come to their financial professional to do that. Now, it's important to note you can take withdrawals from these policies, right? You can access your basis that you've put in tax-free as a withdrawal, but that doesn't help us with the infinite banking concept, because when you take a withdrawal, similar to when you withdraw money from a bank account, you stop earning interest on those dollars, right? So we're strategically wanting to take a loan from these policies. That's how we want to access all of our money out of these insurance policies, because when we take a loan, remember the money's coming from the general account, the insurance company, your money stays in your cash value earning compounding interest, and you get that money outside of the policy to use however you want, right? Most people are using it to create wealth. So that's how you access your funds in your policy in the investing stage. Stage 2, when you're slowing down on investing, I call this the more traditional retirement phase of life, but you can turn on a stream of tax-free income in retirement. So let's say you invested for the last 20 years, you get to the age of 65, you have all of these assets producing cash flow for you, you've got passive income, you've got savings, you've got all of the necessities that you need to be able to live your dream retirement. So you say, hey, now what, Brandon? I've got, $2 million sitting in my cash value in my policy. I've used it for investing. It's been great. What do I do with it now? It's a common question we get from a lot of people. Now you can actually turn that into an additional stream of tax-free income. And here's how you do that. You're going to do it a little bit differently than when you take loans on the policy to invest. The first way you access income from the policy is you can withdraw your basis. Okay, life insurance is unique in that it's first in, first out accounting. So when you put in money, you can take out your basis without touching any of the gains. Okay, so let's say you funded $700,000 into the policy over the last 25 years. There's $2 million of cash value. The first $700,000 you're going to access as income is going to come out as a withdrawal. Once you get to the growth on the policy, once you get through your basis, then we're going to switch back to using policy loans, because we want that money to keep coming to us tax-free. Okay, so when we take policy loans, we're not paying taxes on those, so we get tax-free income from it. We're not going to worry about paying those loans down, and we're just going to let that loan accrue. And then eventually, right, maybe we're 90, 95 years old, we're going to die. And then what happens is that death benefit pays out tax-free. The first portion is going to pay off any outstanding loans. So you're not leaving behind this great debt that somebody's going to have to repay. The life insurance policy itself is going to pay out tax-free and first pay off that debt. And then the remainder, because there's always going to be a remainder, is going to go straight to your beneficiaries, whoever you choose, whether it's your trust or your children. That's going to go directly to them in the form of tax-free death benefit. That's how you access money out of your infinite banking policy. If you have questions, make sure to drop them in the comment below. If you want to dive into this strategy further, go to the link in my bio on my YouTube channel and you can schedule a call there. Make sure to hit that subscribe button. It helps me greatly, and we'll look forward to seeing you on the next video.